Let's understand how banks protect themselves from loan losses and how they handle loans that go bad. Whenever a bank gives a loan, there is always a risk that the borrower might not repay. Loan loss provisions are simply money that banks set aside every year to cover possible future loan defaults. Think of it like a safety fund. The bank estimates how many loans might go bad and keeps some money aside as an expense. This reduces profits today, but it protects the bank tomorrow. Over time, these yearly provisions accumulate. The total of all these past provisions is called loan loss reserves. Loan loss reserves sit on the balance sheet and act like a financial cushion. Whenever an actual loan loss happens, the bank uses this reserve to absorb the loss. These reserves even count as Tier 2 capital, which strengthens the bank's financial stability. But how does a bank decide how much reserve to maintain? Banks look at several factors such as their credit policies, past loss experience, growth in the loan portfolio, quality of management, recovery practices, and overall economic conditions. If the economy looks risky or past losses are high, the bank will keep higher reserves. So in simple words, provisions are yearly savings, and reserves are the total savings built over time. Now let's move to what happens when loans actually become problematic. When a borrower stops paying, the loan becomes a loss asset or non-performing asset. At this stage, banks don't give up immediately. Instead, they start something called a loan workout process. A loan workout is a structured effort to recover as much money as possible and reduce losses. First, the bank may try to reduce its risk by asking for additional collateral, guarantees, or extra capital. Second, the bank may work closely with the borrower. They might help restructure the loan, extend repayment time, reduce costs, or even suggest selling assets to improve cash flow. Sometimes this step feels like financial consulting. Third, the bank might bring in a third party, such as a joint venture partner or a new investor, who can take over or support the business. And if nothing works, the final step is liquidation. This means selling collateral, foreclosing property, or calling guarantees to recover whatever money is possible. From an accounting perspective, banks generally follow two approaches to handle these bad loans. The first approach is retaining loss assets. Here, the bank keeps the bad loans on its books and waits longer to recover money. This approach may make reserves appear larger and is commonly seen in the British system. The second approach is writing off loss assets. In this case, the bank immediately removes the bad loan from its balance sheet and charges the loss against reserves. This cleans up the balance sheet quickly and is common in the US system.